The Warren Buffett Way by Robert G. Hagstrom. Picture this. It's the swinging 60s, and a salad oil company in New Jersey is absolutely crushing it. We're talking so successful that heavyweight financial players, including the legendary American Express, are practically throwing millions of dollars at them. The deal? Simple as it gets. These massive storage tanks, supposedly brimming with liquid gold in the form of vegetable oil. Inspectors would show up, dip their measuring sticks, nod approvingly, and the money would keep rolling in. Then boom, everything explodes. Turns out the whole operation was an elaborate con. The mastermind, a guy named Tino DeAngelis, had figured out something your high school science teacher could have told you. Oil floats on water. His genius move? Fill those giant tanks almost entirely with worthless seawater, topped off with just enough salad oil to fool the inspectors who only ever check the surface. The collateral everyone trusted? Nothing but smoke and mirrors. When the truth came out, Wall Street went into full panic mode. American Express, stuck holding the bag for these bogus loans, watched its stock price get absolutely demolished, dropping by half in the blink of an eye. The financial world was certain this was the end of the road for the company. Everyone was bailing out as fast as they could. But out in Omaha, Nebraska, a young investor saw something completely different. Instead of freaking out over the dramatic headlines and the stock price in freefall, he started asking the most basic questions imaginable. He wandered into local restaurants and just watched. Were people still whipping out their American Express cards to pay? Yup. He dropped by banks. Were folks still grabbing those American Express travelers' checks for their trips? Absolutely. Here's what he figured out. Sure, the scandal was a disaster, but it hadn't touched the real treasure at the heart of American Express. The trust that millions of people had in its products. While everyone else was losing their minds, he was calmly observing reality. So what did he do? He put a massive chunk of his fund into that beaten-down stock. We're talking 40% of everything he had. 2 years later, his investment tripled. His partners made millions. That young guy betting against the crowd? Warren Buffett. And this one story pretty much tells you everything about the man who would go on to become the greatest investor the world has ever seen. No fancy algorithms, no risky gambling. Just thinking differently, seeing a business where everyone else only saw a scary stock ticker. Today we're diving deep into The Warren Buffett Way by Robert G. Hagstrom. This book has moved over 1 million copies, and here's why. It cracks the code on how a genius actually thinks. Hagstrom spent years poring over Buffett's letters, studying his investments, and absorbing his philosophy, then distilled it all into principles that actually stand the test of time. Here's what I'm promising you. By the time we're done here, you won't just know what Warren Buffett buys. You'll understand how he thinks. You'll walk away with a mental toolkit you can use not just for investing, but for making better decisions in pretty much any part of your life. We're about to unpack the beautifully simple logic that helped a guy from Omaha turn $100 into one of the most staggering fortunes in human history. To really get the Warren Buffett way, we need to rewind to the very beginning, not the billions, but a kid absolutely fascinated by numbers. Young Warren wasn't exactly your typical child playing with action figures. He'd park himself on his porch and meticulously record license plate numbers of passing cars. He'd spread out the newspaper on the floor and count how many times each letter appeared. The kid was basically a human calculator, obsessed with patterns and probabilities. His first real business venture was beautifully straightforward. He'd buy a 6-pack of Coca-Cola from his grandfather's grocery store for $0.25, then go door to door selling each bottle for a nickel. 5 cents profit on a 25-cent investment. He was already thinking like an investor before he could probably spell the word. This obsession with making and growing money led him, at just 11 years old, to buy his first stock. He and his sister Doris picked up 6 shares in a company called City Service. He'd studied those price charts and felt pretty confident. Then the stock tanked. Doris panicked hard. Every single day she'd remind him about the money disappearing before their eyes. The pressure was crushing. So the moment the stock climbed back, and they had a tiny $5 profit, Buffett sold. Then he had to watch, in complete agony, as that same stock rocketed to over $200 a share. Talk about a painful lesson, but maybe the most valuable one of his entire life. He made 2 promises to himself right then. First, he'd never let the price he paid for something dictate what he did next. Second, he'd never settle for quick, tiny profits again. At 11 years old, he learned the incredible, almost magical power of patience. But he still needed a real framework, an actual philosophy. He found it in a library book, The Intelligent Investor by Benjamin Graham. For Buffett, reading that book was like, in his own words, seeing the light for the first time. Graham became his mentor, first through his writing, later as his professor at Columbia. Graham taught him 2 ideas that would become the foundation of everything to come. The first was this allegory about a business partner called Mr. Market. Imagine you own part of an amazing business, and every single day, your partner, Mr. Market, shows up at your door. Here's the thing about Mr. Market, though. He's emotionally all over the place. Some days he's on cloud 9, convinced the future is brilliant, offering to buy your share for some ridiculously inflated price. Other days he's in the dumps, certain doom is coming, willing to sell his share for almost nothing. Graham's insight? You don't have to listen to him at all. You can actually use his crazy mood swings to your advantage. When he's depressed and offering bargains, you buy. When he's euphoric and throwing silly money around, you can sell. But you never, ever let his emotional state dictate how you feel about the actual business. The market exists to serve you, not to tell you what to think. You're a business owner, not some gambler betting on numbers. This connects to Graham's second and most famous concept, the margin of safety. It's gorgeously simple. Your job as an investor is to figure out what a business is actually worth, its true intrinsic value. Then you wait patiently until Mr. Market, in one of his gloomy phases, offers to sell it for significantly less. That gap between real value and the price you pay, that's your margin of safety, your cushion against bad luck, mistakes in judgment, and all the crazy unpredictability the economy can throw at you. Armed with these ideas, young Warren Buffett stepped into the world. Early in his investment partnership, he was pure Graham. He was what he later called a cigar butt investor. He'd hunt for companies so beaten down, so unloved, that they traded for less than the actual cash sitting in their bank accounts. Like finding a cigar butt on the sidewalk, with one last puff still in it. Might not be a quality smoke, but hey, it's free. This strategy worked like magic. His partnership posted incredible returns, crushing the market averages year after year. But as time passed, Buffett started seeing the limitations. Buying a mediocre business, even at an amazing price, often just left you with, well, a mediocre business. Time, he realized, is the best friend of a wonderful company, but the worst enemy of a mediocre one. This is where the story shifts, where Warren Buffett evolves. And his evolution was guided by 2 other brilliant minds, Philip Fisher and, crucially, his partner Charlie Munger. Philip Fisher was Graham's complete opposite. While Graham buried himself in financial statements hunting for quantifiable bargains, Fisher was out in the world talking to actual people. He believed that to truly understand a company, you had to investigate every angle. He developed what he called the, quote, scuttlebutt method. He'd talk to customers, suppliers, former employees, even competitors. He wanted to grasp the qualitative stuff. Was this genuinely a great business with a lasting competitive advantage? Was management not just smart, but honest and trustworthy? Fisher wasn't interested in fair companies at wonderful prices. He wanted wonderful companies at fair prices. This idea planted a seed in Buffett's mind. But the person who really made it grow, who pushed Buffett to completely transform his thinking, was Charlie Munger. Munger and Buffett, both from Omaha, were a match made in investing heaven. Munger was brilliant, with a mind that pulled from psychology, history, science, everything. And he constantly challenged how Buffett thought. Munger famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." The turning point came with a company called See's Candies. In 1972, Buffett and Munger had a shot at buying this beloved West Coast candy maker. By every Ben Graham measure, it looked terrible. The asking price was 3 times its book value, 3 times what its physical stuff was worth. The old cigar butt investor in Buffett was screaming, "No way, too expensive." But Munger saw something else entirely. He saw a business with a powerful brand, customers who'd happily pay a bit more each year for their favorite chocolates, and a simple model that generated cash without needing massive reinvestment. He saw a wonderful business. He convinced Buffett to pay up. They bought See's Candies for $25 million. As Munger later put it, this was the first time they actually paid for quality. And it changed everything. That $25 million bet has since generated over $2 billion for Berkshire Hathaway, Buffett's company. See's Candies taught Buffett something profound. Real value isn't just in the stuff you can touch, like factories and inventory. The real lasting value often lives in the intangibles: brand strength, customer loyalty, pricing power. Graham's margin of safety was still the North Star, but the definition of value had expanded. This fusion of Graham's price discipline with Fisher and Munger's focus on quality created the modern Warren Buffett way. It's a philosophy built on clear, powerful principles, what author Robert Hagstrom calls the 12 immutable tenets. We don't need to march through them like a boring checklist, but we can understand them by seeing how Buffett actually thinks about an investment. He groups them into 4 simple buckets. First, the business tenets. His very first question: is this business simple and understandable? Buffett calls this his circle of competence. He knows he doesn't need to be an expert on everything. He just needs to know where his expertise ends. He gets the business of selling soda, insurance, furniture. He understands businesses with long track records. That's why for decades he avoided tech companies. Not because he thought they were bad, but because he couldn't confidently predict what they'd look like in 10 or 20 years. If he can't predict, he won't invest. Next up, does it have a consistent operating history? Buffett has zero interest in turnarounds. He says turnarounds seldom turn. He'd much rather buy a consistently successful business, even if it's going through some temporary fixable problem. And the most crucial business tenet: does it have favorable long-term prospects? This is where he hunts for what he calls an economic moat. A moat is a lasting competitive advantage, protecting a business from rivals, like a moat protecting a medieval castle. A powerful brand like Coca-Cola's? That's a moat. A low-cost operation like Geico's? Moat. Products people are locked into, with high switching costs? Definitely a moat. The wider and more sustainable the moat, the more Buffett loves it. He wants a castle surrounded by crocodiles and piranhas. Once he's confident about the business, he moves to the management tenets. He wants to know, is management rational? For Buffett, a CEO's most important job is capital allocation, deciding what to do with profits. A rational manager only reinvests earnings if they can generate high returns. If they can't, they should return money to shareholders through buybacks or dividends. He can't stand managers who blow company cash on dumb, ego-driven acquisitions just to build bigger empires. He also asks, is management candid with shareholders? Buffett reads annual reports like a detective novel. He wants managers who are honest, who own their mistakes as openly as they celebrate wins. He says a CEO who misleads others publicly might eventually mislead himself privately. Finally, he looks for managers who resist the institutional imperative. This is powerful stuff. It's that lemming-like tendency of corporations to mindlessly copy their peers. If every other company in the industry is making some foolish acquisition, the institutional imperative pressures the CEO to follow along, even if it makes 0 sense. Buffett hunts for independent thinkers willing to look foolish short-term to be right long-term. After sizing up the business and management, he turns to financial tenets. He doesn't get lost in complex metrics, just focuses on a few key things. He prioritizes return on equity over earnings per share. He says any company can grow earnings per share just by keeping its profits. That's like getting excited your savings account grew because you left the interest in there. Return on equity, though, tells you how effectively management uses owners' capital to generate profits, and he wants high returns achieved with little or no debt. He also calculates what he calls owner earnings. This is his version of real cash flow. It's net income plus non-cash stuff like depreciation, minus the average capital expenditures needed to maintain competitive position. This gives him a realistic picture of actual cash the business can generate for owners year after year. And naturally, he looks for consistently high profit margins. Sign of a strong business and cost-conscious management. Finally, the market tenets, the two questions tying everything together. First, what's the value of the business? This goes back to the core philosophy. He defines value as the total of future owner earnings, discounted to today's dollars. Simple idea, but it forces you to think like a long-term owner, not a short-term gambler. Only after all that, analyzing the business, management, and financials to estimate conservative intrinsic value, does he ask the final question: can I buy it at a significant discount to its value? This is the margin of safety, where Graham, Fisher, and Munger all converge. He's hunting for a wonderful business, run by great people, that he can buy at a price giving him substantial cushion. When you put all these pieces together, you see Buffett's process naturally leads to a very specific portfolio management style, completely opposite of what most of the financial world does. It's called focus investing. Most investment advice screams diversify, spread bets across dozens, even hundreds of stocks. If one tanks, it won't hurt much. Buffett thinks this is nonsense for anyone who knows what they're doing. He says diversification is protection against ignorance. It makes very little sense for those who know what they're doing. His logic is simple. Why put money into your 20th best idea when you could put more into your absolute best? His philosophy forces incredible selectivity. He might only find 1 or 2 truly great ideas in a year. When he does, he bets big. Berkshire's portfolio has often had most of its money in just a handful of companies. This requires incredible conviction and patience, means being willing to sit still, sometimes for years, holding cash and waiting for the perfect pitch. As he says, the stock market is a no-cold-strike game. You can stand at the plate watching pitch after pitch fly by, the high flyers, speculative fads, the hot new thing, and it doesn't count against you. You only swing when you see one right in your sweet spot, one you're absolutely confident you can crush. This approach, deep, business-focused analysis combined with a concentrated, patient portfolio, is the engine of his success. But there's one more piece, maybe the most important of all, the psychology of investing. Buffett's real genius isn't just analytical ability, it's his temperament. His mastery over the two emotions that destroy most investors, fear and greed. He stays rational when everyone's panicking, stays disciplined when everyone's caught up in speculative frenzy. He learned from Graham that market mood swings are opportunities, not threats. And from Munger, all the countless ways our minds trick us. We're prone to overconfidence, hate admitting we're wrong, have irrational fear of loss. Studies show losing $1 hurts more than twice as much as gaining one feels good. This loss aversion makes people sell winners too early to lock in small gains and hold losers way too long, hoping to break even. Buffett's immune to these psychological traps. He doesn't care if a stock drops after he buys it, as long as the underlying business stays strong. Actually, he loves it. Gives him a chance to buy more of something great at an even better price. He's not buying a stock ticker, he's buying a piece of a business. Long as the business is doing well, he knows eventually the market price will catch up to business value. His favorite holding period, as he famously says, is forever. This isn't just a clever soundbite, it's the ultimate expression of his philosophy. When you buy a piece of a truly wonderful business, run by people you trust, at a sensible price, why would you ever sell? You just let the power of compounding work its quiet, relentless magic over decades. That's the Warren Buffett way. It's not a secret formula, not a get-rich-quick scheme. It's a philosophy of thinking, a commitment to being a business owner, not a speculator, a discipline of patience, rationality, and independent thought in a world rewarding the opposite. At its heart, it's profoundly simple. But as Buffett's unmatched record proves, it's also profoundly powerful. So what do we actually take from all this? When you step back from the stories and principles, I think the most powerful lesson in the Warren Buffett way is deeply liberating. It's the idea that success in investing has almost nothing to do with being the smartest person in the room. It's not about having a finance PhD or building complex algorithms. It's about temperament, having the right mindset. Buffett himself says, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential, and that's a game anyone can learn. You don't need to be a genius, but you do need discipline. Need to cultivate patience in a world demanding instant gratification. Need humility to admit what you don't know and stay within your circle of competence. The finance world can feel intimidating, designed to make you think you need experts to navigate it. But Buffett's entire philosophy rebels against that. He demystifies the process, brings it back to common sense. You're not buying some complex financial instrument, you're buying a piece of a business. If you can't understand how it makes money, why customers choose it, what its future looks like, you have no business owning it. That's simple. So how can you start applying this thinking right now, even if you're just starting out? First, practice the circle of competence principle. Grab paper and write down industries or businesses you genuinely understand. Maybe you work at a coffee shop and understand that business's economics better than anyone. Maybe you're passionate about video games and have deep insight into which companies have the most loyal fans. Start there. Your knowledge is your edge. Don't get tempted into areas you don't understand, no matter how exciting they seem. Second, become a business analyst, not a market analyst. Next time you hear people talking about where the stock market's headed or what the Federal Reserve might do, consciously tune it out. Instead, pick one company that interests you within your circle of competence and read its annual report. Read the CEO's letter to shareholders. Try answering Buffett's core questions. Is this a good business, run by honest, able people, available at a sensible price? This shift from market speculation to business analysis is the single most important step you can take. Third, cultivate patience. Perhaps the hardest but most rewarding part. Recognize real wealth isn't built overnight. It's built over decades through the slow, steady power of compounding. When you invest, think of it as a 10-year commitment. This long-term mindset frees you from the emotional roller coaster of daily market swings and lets you focus on what truly matters: underlying business performance. The Warren Buffett way isn't just about investing, it's about a way of thinking, about clarity, discipline, and quiet confidence that comes from doing your homework and trusting your judgment, about playing the long game in a world obsessed with short-term scores. That's a lesson serving you well, not just in your portfolio, but in every aspect of life. That was a summary of The Warren Buffett Way by Robert Hagstrom. We've explored the core of Buffett's philosophy today, but I'll be honest, a summary is like looking at a photograph of a great meal. You can see what it's made of, but you can't truly taste it. The real magic happens when you read the book yourself. It's in the detailed case studies, subtle insights, how principles build on each other. This summary helps you decide if this book deserves your time. If anything we've talked about sparked your curiosity, I encourage you to grab a copy. Reading it isn't just learning. It's an apprenticeship with the greatest investor of all time. You'll find a link in the description below. Also, if you found this summary valuable, please hit that like button and subscribe to our channel. Tells us we're on the right track and ensures you won't miss our next journey into another life-changing book from the Billionaire's bookshelf. Let's keep growing together.